Welcome to the Deep Dive. We're here to cut through all the noise and get you informed fast. Today, we're taking a really close look at a company that, well, it probably touches your life multiple times a day, Microsoft. We're not just looking at it as a tech giant, though. It's more like a fascinating case study. How does a huge, mature company like this handle innovation, the market, its finances? And we have got quite a stack of material to go through for this.
That's right. Our job today really is to sift through, all the financial reports, the corporate stuff, the research, and pull out the key insights. What's happening with Microsoft's recent performance? What's their core business really about? And what about the future? We want to help you get a solid, informed perspective pretty quickly, cutting straight to what matters in all this data.
Yeah, and the sources are pretty comprehensive. We've got the latest earnings, that's Q4 fiscal 25. We've got deep dives into their business model, how it all fits together, financials going back a decade, and even this Buffett-style checklist we ran them through. So, okay, let's dive right in. All right, kicking things off with the latest numbers. Quarter ended June 30, 2025. Another really, really impressive quarter. They reported revenue of $76.4 billion. That's up 18% year over year.
Huge number.
Huge. Operating income, $34.3 billion, up 23%. Net income, pretty close behind, $27.2 billion, up 24%. And the big driver here, jumps right out, cloud and AI. Azure specifically showing, what, 39% year-over-year growth?
39%, yeah. And you're seeing that AI-enabled Microsoft 365 Copilot really starting to show up in the results across the productivity suite, too. What's fascinating here, though, isn't just the Azure growth itself, though that's massive. It's how they're positioning themselves, like the picks and shovels provider for this whole AI gold rush.
Yeah.
And that operating margin, around 45% for a company this size. That's incredibly strong. It shows they're not just, chasing growth. They're converting sales into real profit. That's a key differentiator. And Microsoft Cloud revenue hitting $46.7 billion, up 27% year over year. That just shows the sheer scale of their integrated cloud offerings.
46.7 billion just in the cloud segment.
Exactly. And management's guidance, looking ahead to fiscal 26, they're talking mid-teens revenue growth.
Yeah.
That signals they really expect this cloud momentum to continue. It's not just a blip.
So it's not just the volume, it's the quality of that growth, that high margin. Does that also give them more flexibility maybe to handle these huge investments we keep hearing about in AI?
Absolutely. That kind of profitability is crucial. It generates the cash they need to fund these really aggressive long-term bets on AI infrastructure. And they can do it without, overly stressing their balance sheet or needing tons of outside money. It's a virtuous cycle, really. Strong margins fuel investment, which then fuels future growth.
Okay, so how does Microsoft actually make all this money day to day? It seems to come down to three big platforms, and they seem pretty synergistic. For fiscal 25, you had productivity and business processes. That's like Office 365, Teams, LinkedIn. That brought in $120.8 billion, about 36% of total revenue.
Biggest chunk.
Then Intelligent Cloud, Azure, server products. That was $106.3 billion, or 32%. And finally, more personal computing, Windows, Xbox devices. That was $75.0 billion, about 22% of revenue. And the scale. It's just kind of mind-boggling when you look at the user numbers.
Yeah.
Like 89 million Microsoft 365 consumer subscribers, an estimated 350,000 companies paying for Azure and LinkedIn, 1.1 billion members. Sometimes I feel like everyone I know and everyone they know must be on LinkedIn. It's just huge.
It really drives home the network effect they have.
Right. Plus, roughly 180 million Windows licenses shipped, 34 million Xbox Game Pass subs, over 4 million paid users for GitHub Copilot.
And if we connect this to the bigger picture, you see, Microsoft isn't just selling individual bits of software. They're building this integrated digital ecosystem. These segments aren't really silos. They feed each other.
How so? Like, give me an example.
Well, think about LinkedIn. All that professional data could fuel AI insights within Microsoft 365, making business processes smarter. Or how Azure, the cloud platform, powers all the new AI capabilities that then get embedded everywhere else in Windows, in Xbox, in Office. It's this interconnectedness. It creates a powerful lock-in, especially for businesses. They build on Azure, they use Teams, they rely on Copilot. It all works together. Owning that AI layer is key.
You mentioned these synergistic platforms, but, some critics might say, okay, they look integrated, but they still face really different competitors in each area.
Yeah.
How much real synergy is there versus just having a collection of very successful, but maybe distinct businesses?
That's a fair question. And competitors definitely try to poke holes in that integration story. But I think what the strategy and the results show is that the integration is, well, it's pretty deep and strategic. like Copilot in Microsoft 365, that fundamentally relies on Azure infrastructure.
Right. It wouldn't exist without it.
Exactly. And developers building on Azure often means they're also building for Windows or integrating with Teams for collaboration. It's about creating that unified experience for the enterprise customer. Makes it harder and harder to just swap out one piece without disrupting everything else. It feels like a cohesive strategy, not just a bundle of assets.
Okay, we've seen the power in the recent numbers. We see how they make money. But, well, even a giant like Microsoft faces challenges, right? They can't all be smooth sailing. As you look through the sources, what are some of the bigger risks or headwinds you picked up on?
Yeah, that's where it gets really interesting. Short term, there's a couple of things. One is a potential slowdown in the PC market. The big Windows 11 upgrade cycle driven by the pandemic and work from home might be cooling off.
Yeah.
We also saw some FX volatility. That's just, currency swings. It trimmed about 1 percentage point off their Q4 revenue. Basically, a stronger dollar means overseas earnings are worth a bit less when brought back home.
Right, the exchange rate effect.
Exactly.
Right.
And then there's the ever-present regulatory scrutiny. That impacts things like the big Activision acquisition, maybe future AI deals. It could mean more costs, maybe some pressure on margins down the line.
And looking out longer term, you mentioned the heavy investment. That raises a question, doesn't it? How do they balance investing so aggressively, especially in AI, while keeping up that profitability we talked about?
That's the multi-billion-dollar question, literally. We're talking huge, sustained AI capital expenditures. Projections are over $30 billion just in fiscal 26.
$30 billion. Wow.
Yeah. That kind of spending could put pressure on free cash flow, at least in the short to medium term. Then you have ongoing antitrust stuff. The EU Digital Markets Act, investigations by the US DOJ. These can bring restrictions on how they operate. And we can't ignore competition. The potential for open source AI models or just price wars between the big cloud providers like AWS, Google Cloud, and Azure that could potentially eat into Azure's margins over time. If that happens, it impacts their return on invested capital, their ROIC, basically how well they turn their investments into profit. So yeah, it's a real balancing act. Spend big to lead, but make sure it pays off.
Let's peek inside the engine room then, the cost structure for fiscal 25. What really leaps out is that capital expenditure number, $45 billion. Up 78% year over year.
78% increase. That's massive.
It's not just keeping the lights on. That's a huge bet on building out AI infrastructure, data centers. It tells you exactly where their focus is. Beyond that, cost of revenue, estimated around $110 billion. That's largely variable, tied to cloud usage, servers, power, etc. R&D is about $30 billion, and SG&A selling, general, and admin around $32 billion. But yeah, that CapEx number really dominates. It reflects this intense Azure and AI build-out. Maybe it moderates a bit if utilization catches up, but right now, it's pedal to the metal.
And driving all this is a management team with a really remarkable track record. Stability and execution. Satya Nadella, CEO for 11 years now. Amy Hood, CFO for 12 years.
That's a long tenure in tech.
It is. And look at the results.
Yeah.
They've met or beaten guidance in, 36 of the last 40 quarters? That's incredible consistency. And importantly, no major accounting scandals or issues. The board looks strong too. 12 independent directors. Includes people like Indra Nooyi, former CEO of PepsiCo. That signals good governance. And tighter ownership is pretty low overall, less than 1%. But Nadella himself holds about 0.02%, which, given Microsoft's size, is still a very significant personal stake, aligning him with shareholders. And shareholders seem happy with leadership. Executive pay approval has been over 95% consistently since 2017.
So who actually owns the bulk of Microsoft? The big institutions, right? Looks like BlackRock has about 7.9%, Vanguard 7.7%, State Street around 4.0%. And it's interesting to see how these big players use their votes. At the 2024 annual meeting, they mostly backed things like ESG and climate disclosures, but there was some dissent. Vanguard opposed a proposal on halting facial recognition sales. State Street withheld on an executive pay item. It shows there's still some push and pull, even with a giant like Microsoft.
Definitely. And Microsoft, for its part, is committed to returning capital to those shareholders. That shows confidence from management. They have that ongoing $60 billion share buyback plan authorized back in September 2024. That works out to buying back roughly 2% of their shares each year, pretty consistent with what they've done before.
So steadily reducing the share count, boosting EPS.
Exactly. What's also quite telling is the value investor interest. The Bill and Melinda Gates Foundation Trust. Microsoft is a massive part of their portfolio. 25.5% of their entire $42 billion trust is in MSFT.
Wow, that's huge concentration.
It's a huge position. And even Berkshire Hathaway has a small, sort of hidden position through a subsidiary. Buffett hasn't bought directly recently, but it's there. That kind of conviction from major long-term focused investors really speaks to the perceived stability and long-term value. They clearly see it as a core holding.
Okay, let's zoom out a bit now. Look at the last decade or so. Fiscal 2015 through 2024, plus the trailing 12 months, the growth is just, well, it's seriously impressive. Back in 2015, revenue was around $93.6 billion,
Hmm.
net income $12.2 billion, free cash flow $24.7 billion. Fast forward to fiscal 2024, revenue nearly tripled to $245 billion, net income surged to $88 billion, free cash flow hit $74 billion.
It's incredible scale.
And the latest trailing 12 months, revenues at $270 billion, net income $96.6 billion, free cash flow around $85 billion. It really paints the picture of this transformation from, the old software giant to this cloud and AI powerhouse.
So let's try putting Microsoft through that Buffett-style checklist. See how it stacks up against some classic value investing benchmarks, which usually favor stability and, well, being cheap. It actually passes a lot of them with flying colors.
Like what?
Okay, free cash flow margin. Has it been over 5% for 10 years? Yes, easily. It's averaged a really strong 27%. Return on equity, average over 15% for 10 years. Yes, again, average an impressive 35%. Debt-to-equity ratio below 0.5. Yep, it's around 0.46. Very healthy.
Yeah.
Interest coverage. Can they easily pay their debt interest? Oh, yeah.
Yeah.
Over 25 times coverage. That's incredibly safe.
Okay.
And the book value growth rate, the compound annual growth rate of book value per share, over 10%. Yes, it's been 11%.
So financially healthy, efficient, growing its intrinsic worth by those measures. It ticks almost all the boxes. But where does it maybe stumble according to that traditional Buffett lens?
Right. This is where the classic definition of value gets stretched. It kind of fails by
Right.
those traditional metrics on valuation.
Yeah.
The current price to earnings ratio, PE, is around 28.9. A strict value investor might look for 15 or less.
Much higher.
Much higher. Price to book ratio is 13.2. Again, significantly higher than the traditional benchmark of, say, 1.5. And there was one slight dip in earnings per share back in fiscal 2023. So not perfectly consistent upward EPS growth over the whole period.
So this isn't just about Microsoft failing a test. It really makes you ask, doesn't it? In today's world, with tech growing so fast, network effects, are those classic valuation metrics enough? Or is a company like Microsoft kind of rewriting the playbook for what value means? Maybe potential and market dominance count for more than just looking at past earnings multiples.
That's exactly the debate. A traditional Buffett approach looks for companies trading below what their historical earnings and assets suggest they're worth, buying a dollar for 50 cents kind of thing.
Right.
But with Microsoft investing billions in AI, leading in the cloud, the market is clearly pricing in a lot of future growth, a lot of confidence in their continued competitive advantage, their moat. So it's less about buying cheap based on the past and more about buying into a future growth story that's expected to deliver way more than today's dollar value down the road.
Yeah.
It forces you to think about how much of that future potential is already reflected or baked in to the current stock price.
Which leads us to the big question. What is Microsoft actually worth? We ran some numbers, some intrinsic value estimates, used 3 scenarios: conservative, nominal, optimistic, different assumptions about growth rates, discount rates, projecting future cash flows. This gives us a range for intrinsic value per share, from about $360 on the conservative side up to maybe $620 in the optimistic case.
A pretty wide range reflecting the uncertainty in those long-term projections.
Right. And if you apply a 25% margin of safety, a buffer, basically our theoretical buy price targets would be somewhere between $207 and $465 per share.
Okay, so how does that compare to where the stock is actually trading now?
Well, the current market price is around $513.
Right, so $513. That puts it sort of at the upper end of our nominal to optimistic range, maybe even a bit above the margin of safety by price for the optimistic scenario.
Yeah.
Looking at it another way, that current price implies an expected return of about 9.2% using the Buffett method calculation. That's essentially the discount rate needed to make the future cash flows equal today's price.
9.2% implied return.
Yeah, which makes you think, okay, what level of future growth and performance is the market already assuming to justify that price? It suggests investors have a very high degree of confidence in Microsoft's ability to keep innovating and leading. It definitely frames the decision for potential investors.
Okay, so wrapping this all up. After this deep dive into Microsoft, what are the key takeaways? Well, the core insights seem pretty clear. This is a company on a really powerful growth path, driven hard by cloud, and a very strategic, aggressive push into AI. Its business model is incredibly robust, diversified across those three synergistic pillars. It creates this really potent ecosystem, and it's run by a stable, proven leadership team that just keeps delivering.
Hmm.
But there are challenges. Those massive ongoing capital costs for AI infrastructure are real, and the regulatory environment is getting more complex, it seems. So you have this interesting tension. Undeniably strong fundamentals, great execution, but a valuation that, viewed through traditional metrics, looks pretty stretched. It really pushes us to think about what value even means for a tech leader like this today.
So here's a thought to leave you with. Considering Microsoft's huge ongoing AI investments and where the market values it right now, what do you think is the single most crucial factor we should watch? Maybe it's a specific future tech breakthrough they need, or a major shift in the competitive landscape, perhaps someone challenging Azure more directly, or maybe even a big change in how regulators approach AI globally. What's the one thing that would truly validate or maybe seriously challenge the sustainability of this growth path and justify or undermine its current price in the long run? Something to think about.
Definitely something to keep in mind as you watch the tech world evolve and see how giants like Microsoft continue to shape it. And as always, please remember that this content expresses the views of the author as of the date indicated and is subject to change without notice. Lulu Ventures LLC has no duty to update the information herein. Past performance is not a guarantee of future results. All investments carry risk. The material presented is for educational purposes only and should not be construed as an offer, solicitation, or recommendation to buy or sell any security. Always conduct your own due diligence before making any investment decisions.